Retail panic sold the bottom. Whales bought it. And in the last 12 hours, Bitcoin just proved, in the most brutal way possible, exactly who was right. If you sold yesterday, this video is going to sting a little, but stick with me because understanding why this happened is the only way to make sure it never happens to you again. What if I told you that the precise moment thousands of over-leveraged traders were slamming the sell button in pure panic, convinced the top was in and the party was over? The largest wallets in the entire market, the ones holding tens of thousands of Bitcoin each, were doing the complete opposite. They were buying, quietly, aggressively. And now, less than 24 hours later, the chart has flipped, the shorts are trapped, and Bitcoin is trading right back up near $65,000. So in this video, we're going all the way underneath the surface, into the on-chain data, the exchange flows, the ETF picture, the regulatory landscape in Washington, and the exact technical levels that decide what happens next. Stick around till the end, because the last third of this video is where the real edge lives, and it's the part almost nobody on your feed is talking about. Let's set the scene first because context is everything, and without it, these numbers are just noise. As of right now, Bitcoin is trading right around $64,900 to $65,000. That number by itself doesn't sound dramatic, but look at the move that got us here. Just yesterday, Bitcoin was sitting at around $62,200. Over the previous days, it had slid from the mid-60s down into the low 60s, and then it flushed hard towards 62,000 in a fast, violent leg down that liquidated hundreds of millions of dollars in long positions. The mood was ugly. Sentiment was in the fear zone. Every headline was about the Fed getting hawkish, about Michael Saylor's strategy pausing its Bitcoin buying, about ETF outflows. It genuinely felt to a lot of people like the beginning of a deeper breakdown. And then, overnight, Bitcoin ripped almost 4.5% to the upside, a move of over $2,700 in a single session, snapping right back towards 65,000. That is one of the sharpest single-day reversals we've seen this summer, and it happened at the exact moment retail conviction was at its lowest. Now, before we go any further, I want to make sure we're all speaking the same language because a lot of what makes this story so powerful comes down to understanding a few key mechanics. So let's start with the word that dominated yesterday's headlines: liquidation. A liquidation happens when a trader borrows money, uses leverage, to make a bigger bet on price than their own capital would allow. If the market moves against them far enough, the exchange forcibly closes their position to prevent further losses. When you have hundreds of millions of dollars in leveraged long positions all stacked up and price starts dropping, those positions get liquidated one after another. Each forced sell pushes the price a little lower, which triggers the next liquidation, which pushes it lower again. It's a domino effect on a cascade. And that's exactly what we saw on the way down to 62,000. It was not, I repeat not, a case of long-term holders suddenly deciding Bitcoin was doomed and dumping their coins. It was over-leveraged short-term traders getting mechanically, forcibly flushed out of the system. That distinction is the single most important thing to understand about this entire move, because mechanical forced selling and genuine conviction selling look identical on a red candle, but they mean completely opposite things for what comes next. Here's why that matters so much. When a market gets flushed of its excess leverage, it actually gets healthier, not weaker. Think of it like clearing out the weak, overextended hands. All those traders who were betting with borrowed money they couldn't really afford to lose, they're gone now. They've been washed out. And when they're gone, there's far less fuel left for another downward cascade because there are fewer forced sellers left to trigger. That's precisely why, so often in Bitcoin's history, the sharpest recoveries come immediately after the most brutal liquidation events. The flush clears the deck, and then the market, now lighter, cleaner, and with the weak hands removed, is free to reverse. That is very likely a big part of the mechanical story behind this overnight bounce to 65,000. But the mechanical story is only half of it. The other half, the more interesting, more important half, is what the on-chain data was showing while all of this was happening. Because while price was dropping towards 62,000, while liquidations were cascading, while retail was capitulating, the whales were not scared. They were accumulating. On-chain analytics showed large holders, the wallets holding between 1,000 and 100,000 Bitcoin, pulling coins off exchanges and moving them into cold storage during the exact window that retail was panic selling. We're talking about thousands of Bitcoin, hundreds of millions of dollars worth, being withdrawn from exchanges as the price bottomed. And this fits a much larger pattern that's been building for months. Whale wallets have accumulated on the order of 270,000 Bitcoin over a 30-day accumulation window, worth roughly $16.5 to $16.7 billion at current prices. That has been described as one of the largest whale accumulation waves in years. And here's the kicker. That accumulation has been happening in June and July, even as spot Bitcoin ETFs posted record outflows, with June alone seeing something like $4.5 billion leave the funds. So you had institutions pulling money out through the ETF wrapper, while whales were quietly scooping up the coins on the other side. That divergence is one of the most telling signals in this entire market. Now, why does it matter so much whether Bitcoin is sitting on an exchange versus locked in cold storage? Let me break this down because it's crucial. When Bitcoin sits on an exchange, it's liquid, it's ready to be sold at a moment's notice. High exchange balances generally mean more potential selling pressure. The coins are loaded in the chamber, ready to fire. But when Bitcoin moves off an exchange and into cold storage, a private self-custodied offline wallet, it's a signal that the holder is not planning to sell anytime soon. They're taking their coins off the market, out of circulation, and locking them away for the long haul. So when you see whales pulling Bitcoin off exchanges during a price dip, that is not the behavior of someone who thinks price is about to collapse. That is the behavior of someone who thinks price is cheap and wants to accumulate for the long term. It's the on-chain equivalent of quietly buying up all the discounted inventory while everyone else is sprinting for the exits. And this brings us to one of the most important concepts in all of crypto, a concept that yesterday and today just illustrated in real time. It's the transfer of coins from weak hands to strong hands. Weak hands are the traders who fold under pressure, who can't stomach the volatility, who buy near the top when it feels euphoric and safe, and who sell near the bottom when it feels terrifying. Strong hands are the holders who accumulate through the fear, who see a dip as an opportunity rather than a threat, and who have the conviction and the capital to hold through the pain. What we just witnessed, retail capitulating at 62,000 while whales accumulated, followed immediately by a sharp reversal to 65,000, is a textbook, real-time example of a transfer from weak hands to strong hands. The coins moved from the panicked to the patient, from retail to whales, from exchanges to cold storage, and the ones who sold got to watch, mere hours later, as the very bottom they sold at became the launch pad for a 5% rally. Let me reinforce this with the sentiment data because it makes the lesson unmistakable. Heading into this bottom, the Crypto Fear and Greed Index, a metric that measures overall market emotion on a scale from 0, extreme fear, to 100, extreme greed, was sitting deep in the fear zone, down around 20 to 22, reading as extreme fear. And here is the contrarian lesson that separates the professionals from the amateurs. Extreme fear is historically one of the best buying opportunities in Bitcoin's entire history. Think about the logic. When is Bitcoin cheapest? When everyone is terrified. When is it most expensive? When everyone is euphoric and greedy. The index being pinned in extreme fear meant the crowd was scared, sentiment was washed out, and the bulk of the weak selling had likely already happened. There's a famous Warren Buffett line that fits this moment perfectly. Be fearful when others are greedy, and greedy when others are fearful. Yesterday, others were extremely fearful. The whales were being greedy. And within hours, the market rewarded the greedy and punished the fearful. That is the pattern. It repeats. And once you internalize it, you start to see these moments not as things to fear, but as things to prepare for. But, and I want to be completely honest with you here, because I'm not in the business of selling you a fairy tale or turning you into a reckless permabull. This bounce does not mean every problem has vanished, and it's straight up from here. Balance matters. Good decisions come from seeing both sides clearly. So let's talk honestly about the bearish forces that are still in this market, because they haven't disappeared just because we got a green candle. The first real concern is the ETF flow picture. Spot Bitcoin ETFs were one of the biggest bullish stories of the last couple of years. They opened the door for institutional and traditional money to buy Bitcoin through a regulated, familiar wrapper, but recently those flows have been rough. June saw record outflows on the order of $4.5 billion. There have been multi-week stretches of consistent net outflows, and some analysts have gone so far as to describe it as a potential structural break in institutional demand. Now, ETF flows are one of the clearest windows we have into what big traditional money is doing. And when that money is flowing out rather than in, it removes a major source of steady buying pressure. The picture is genuinely mixed. There have been days and weeks of renewed inflows, and cumulative inflows on the year are still substantially positive. But the recent trend has been far less one-directionally bullish than during the peak of the ETF hype. So this is a real headwind, and for this rally to have staying power, we'd want to see those flows flip decisively and consistently positive again. The second concern is the Federal Reserve and the broader macro environment. Part of what drove the recent weakness was a more hawkish tone from the Fed. Comments interpreted as signaling the central bank is more worried about persistent inflation than about supporting risk assets, with chatter about rates staying higher for longer. Why does this matter for Bitcoin? Because despite the digital gold narrative, Bitcoin still trades like a high beta risk asset in the short term. When the Fed sounds hawkish and rates stay elevated, liquidity tightens, money gets more expensive, and speculative assets get sold first. Higher rates also raise the risk-free return you can get just sitting in treasuries, which makes a volatile asset like Bitcoin comparatively less attractive to short-term money. So until the Fed's tone softens, until we get cooler inflation data or a genuine dovish pivot, this macro overhang remains a legitimate weight on the market, and it can cap rallies just as easily as it can trigger flushes. The third concern relates to the nature of this very bounce. We have to ask honestly, is this rally driven by genuine, sustainable spot demand, or is a big part of it a short squeeze? A short squeeze happens when traders who bet against Bitcoin, the shorts, get forced to buy back their positions as price rises, which pushes price even higher in a temporary mechanical spike. Given how oversold the market was and how many were positioned bearishly into that 62,000 flush, it's very likely that at least part of this overnight rip to 65,000 was fueled by shorts getting squeezed. That's not inherently bad. Squeezes can kick off real trend reversals, but a rally built purely on forced short covering, with no genuine spot buying underneath to hold it up, can exhaust itself quickly and fade. So the real test isn't the initial spike, it's whether Bitcoin can hold these gains and build on them in the days ahead. Now here's a factor that's genuinely new and genuinely important, and it cuts to the bullish side of the ledger. What's happening in Washington right now? This week has been designated Crypto Week in the House of Representatives, with lawmakers taking up major pieces of crypto legislation, including the Clarity Act, which aims to establish a clear regulatory framework for digital assets, and the Anti-CBDC Surveillance State Act. Why does this matter so much? Because for years, one of the single biggest overhangs on Bitcoin and the entire crypto industry has been regulatory uncertainty. Businesses didn't know the rules. Institutions were cautious because they feared enforcement actions or sudden reclassifications. Clear, favorable regulation removes that uncertainty. It gives institutions the confidence to allocate capital knowing the rules of the game. So the timing here is significant. A major regulatory push in Congress landing in the same window as a sharp price reversal, and heavy whale accumulation is the kind of confluence that can turn a bounce into something more durable. It's worth watching the actual outcome of these bills closely, because the market's reaction to whatever passes, or fails, could be a major catalyst in either direction. Okay? Let's put on our technical hats now and get into the actual chart, because this is where you convert all this narrative into a concrete, actionable plan. Levels matter. Structure matters. Let's walk through it. The single most important level in the entire Bitcoin market right now is the 200-week moving average. This is the average price of Bitcoin over the last 200 weeks. Roughly 4 years of price data smoothed into a single line. Why is it so critical? Because historically, the 200-week moving average has acted as the ultimate bull market floor. In previous cycles, Bitcoin has only very briefly dipped below it during the absolute deepest, darkest moments of bear markets, and those moments turned out to be generational buying opportunities. As long as Bitcoin holds above this line, the long-term bull structure remains technically intact. That line currently sits down in the low $62,000 region, which means yesterday's flush to 62,200 was a direct test of it, and the market held. It bounced right off that zone and reversed hard. That is a technically significant event. It means the ultimate long-term floor was tested under maximum fear, and it held. Bulls could not ask for a much cleaner defense of the most important line on the chart. Now let's map the specific support levels, the price zones where buyers are likely to step in and defend. The first and most immediate support now sits in the 60,000 to 61,400 region, 2E. This overlaps with the 200-week moving average and the recent lows, and it's the zone that just got defended so decisively. As long as Bitcoin holds above this, the structure is healthy, and the reversal thesis stays intact. Below that, the next major support is the psychological $60,000 round number, where large clusters of buy orders tend to sit. Below 60,000, we'd be looking at a deeper demand zone around 58,000 to 58,500 fours, a region that has attracted real buying interest historically. And in a true worst case, the final floor would sit down in the mid-50,000s. Let me be crystal clear, I am not predicting we go back down there. Yesterday's action strongly suggests the opposite. But I map the terrain so that no matter what happens, you have a plan, and you're never caught off guard. The bullish thesis would only really be invalidated by a sustained, decisive weekly close well below the mid-50,000 region. Now the resistance levels, the price zones where sellers are likely to appear and slow a rally down. The first immediate hurdle is right around $65,000 to $65,150, which is essentially where we're trading right now. Bulls need to push through and crucially close above this zone on higher timeframes to prove the momentum is real and not just a short squeeze spike. The next major resistance sits at $66,000 DAS, a level that has repeatedly acted as a ceiling in recent weeks. Clearing 66,000 with conviction would be a genuinely bullish structural development and would open the door toward the upper 60s. Beyond that, The bigger picture resistance clusters up in the 70,000 to 72,500 region, where a cluster of major moving averages sits. Reclaiming that zone would essentially confirm the correction is over and the next real leg up is underway. So the upside roadmap is clear and simple. Hold 65, break 66, then challenge the 70 to 72,000 cluster. Each level reclaimed is a step toward full confirmation. Let me also touch on the RSI, the Relative Strength Index, because it's one of the most useful momentum tools and I want you to understand what it's telling us. The RSI measures whether an asset is overbought or oversold on a scale of 0 to 100. Above 70 is generally considered overbought, meaning a move may be overextended and due for a pullback. Below 30 is generally considered oversold, meaning selling may be overdone and a bounce could be coming. Into yesterday's flush, the RSI had cooled down toward oversold territory, which combined with the extreme fear reading was a classic setup for exactly the kind of reversal we just got. Now, after this sharp overnight rally, the RSI has snapped back up toward more neutral territory. What we'll want to watch from here is whether it can push toward the higher end without immediately getting overbought again. A healthy, sustainable uptrend climbs steadily, whereas a violent spike straight into overbought territory often signals a move that's stretched and vulnerable to a pullback. So keep an eye on the RSI over the next few days as a gauge of whether this rally has legs or whether it needs to cool off and consolidate first. Now let's zoom all the way out and synthesize everything, because this is the part that ties it together and gives you the real takeaway. Here's what we know. On the bearish side of the ledger, the Fed remains hawkish and macro liquidity is tight. ETF flows have been choppy with a record June outflow. Part of this bounce is likely short squeeze driven and needs to prove itself, and strategy has paused its reliable buying. On the bullish side, whales have been aggressively accumulating and pulling coins into cold storage. Around 270,000 Bitcoin worth roughly $16.5 billion over a 30-day window. Sentiment was pinned in extreme fear, a historically powerful contrarian buy signal. The brutal liquidation flush cleared out over-leveraged longs and reset the market, removing fuel for further downside. The 200-week moving average key, the single most reliable long-term floor in Bitcoin's history, was tested and decisively held. Bitcoin just reversed nearly 5% off that level. And on top of all that, we have major favorable crypto legislation being taken up in Congress during Crypto Week. When you weigh both sides honestly, the balance of evidence has tilted meaningfully toward the bulls over the last 24 hours. That doesn't mean it's straight up from here with no pullbacks. It never is. But the confluence of whale accumulation, extreme fear, a held major support, a sharp reversal, and a regulatory tailwind is exactly the kind of combination that has historically marked important local bottoms. So let me give you 3 concrete scenarios, so you're prepared for whatever actually unfolds rather than betting everything on a single prediction. Because the traders who survive and thrive are the ones who plan for multiple outcomes, not the ones who fall in love with one guess. Scenario 1. The bullish continuation. In this scenario, the reversal is real. Bitcoin holds above the 60,000 to 61,000 support. The whale accumulation proves prescient. Crypto Week delivers favorable regulatory clarity, and ETF flows begin to flip positive. Bitcoin pushes through 66,000 and then starts working toward the 70 to 72,000 cluster. In this scenario, yesterday's 62,000 flush becomes the exact bottom that everyone who panic sold will wish they'd bought instead. The signals to watch for confirmation. Strong daily and weekly closes above 66,000, ETF flows turning decisively positive, favorable outcomes on the crypto bills in Congress, and the fear and greed index climbing out of the fear zone. Scenario 2. The consolidation and chop. In this scenario, the bounce holds, but it doesn't immediately rocket. Bitcoin gets stuck in a choppy, frustrating range between roughly 61,000 and 66,000 for a while, digesting the macro uncertainty, waiting on the Fed and on the regulatory outcomes, and slowly building a base. This is actually a very common and healthy way for markets to behave after a sharp move. They consolidate, they build energy, they let the moving averages catch up, and they shake out impatient traders before the next real leg. In this scenario, patience is the name of the game, nothing gets decided quickly, and the winners are those who don't get chopped up trying to trade every wiggle. Scenario 3. The failed bounce and retest. In this scenario, the bearish forces reassert themselves. Maybe the bounce turns out to be mostly a short squeeze that fades, the Fed stays aggressively hawkish, ETF outflows accelerate again, or the regulatory push disappoints. Bitcoin then rolls back over and retests that 62,000 region and the 200-week moving average once more. Here's the key though. Even in this scenario, as long as that major support holds on the retest, the broader bullish structure stays intact. Retests of a defended level are common and often healthy. The bullish thesis would only truly be invalidated by a sustained, decisive weekly close well below the mid-50,000s. Short of that, even a retest could simply be the market building a stronger base before the next move up. So which scenario plays out? Nobody knows for certain, and anyone who tells you they know with certainty is either lying to you or lying to themselves. But now you have a framework. You know the levels, you know the catalysts, you know what the smart money did, and you know exactly what signals to watch for to tell which scenario is unfolding in real time. Let me leave you with a practical checklist, the exact things I'd be watching over the coming days and weeks to stay ahead of this market. Number 1, watch whether Bitcoin holds above the 60,000 to 61,000 support and the 200-week moving average. Holding it keeps the reversal alive. Number 2, watch the 66,000 resistance. Reclaiming it on a strong close is the confirmation that momentum has genuinely shifted back to the bulls. Number 3, watch the ETF flows. Consistent inflows returning would be a major sign that institutions are stepping back in. Number 4, watch the whale wallets and exchange balances. As long as whales keep accumulating and exchange balances keep falling, the strong hands thesis stays intact. Number 5, watch Crypto Week and the regulatory outcomes. Favorable legislation could be a powerful tailwind. Disappointment could be a headwind. Number 6, watch the Fed narrative. Any shift from hawkish toward dovish, any hint of rate cuts or cooler inflation would be rocket fuel. And number 7, watch the Fear and Greed Index. As it climbs out of fear, that's often when recoveries gain real, durable traction. Here's the bottom line, and I want you to really sit with this one because it's the whole lesson of the last 24 hours compressed into a single idea. The headlines yesterday told you Bitcoin was breaking down, the Fed was the enemy, Saylor stepped back, and the top was in. That was the surface. And the surface is designed to make you emotional, to make you panic and capitulate at exactly the wrong moment. But underneath that surface, the data told a completely different story. The largest, most sophisticated players in the market were quietly accumulating while the crowd was terrified. Coins were moving from weak hands to strong hands. Leverage was being flushed. Sentiment was washed out. The most important long-term floor was being tested. And then the market reversed and rewarded the patient while punishing the panicked, exactly as it has done over and over throughout Bitcoin's entire history. That doesn't guarantee what comes next. But it should teach you something permanent about how this market works and about which side of these moments you want to be standing on. If this breakdown helped you understand what actually happened beneath the noise, do me a favor and smash that like button, because it genuinely helps this channel reach more people who need to hear the real story, instead of the fear-driven headlines that got so many people to sell the exact bottom. Subscribe and turn on notifications, because in a market that moves this fast, being a single day late can be the difference between opportunity and regret. And I'll be tracking every one of these signals for you as it develops. Drop a comment and let me know. Did you buy the dip? Did you sell? Or did you sit on your hands and watch? And tell me which scenario you think plays out from here, the bullish continuation, the chop, or the failed bounce and retest. I read the comments and I genuinely want to know where your head is at. And remember, and I cannot stress this enough, nothing in this video is financial advice. I'm not your financial advisor. This is analysis and education based on the data available right now, and this market can and will do things nobody expects. Never invest more than you can afford to lose. Never use leverage you don't fully understand. Yesterday's liquidation cascade is a perfect, painful reminder of exactly why. Always do your own research, manage your risk, protect your capital, and think in terms of years, not days. Because the people who actually win in Bitcoin aren't the ones who make the flashiest single trade. They're the ones who are still standing after the volatility has shaken everyone else out. Stay sharp, stay patient, stay disciplined, and I'll see you in the next one.